As it is correctly said by Scott Cook, that mutual funds were created to make investing easy so consumers wouldn't have to be burdened with picking individual stocks. We are well aware of hardships a common man faces when it comes to picking investments to meet their particular goals. But what if we didn't have to do all that work and we had a professional do that for us and offer us a fund that invests in securities that meet our goals? Well, that's exactly what a mutual fund does. So mutual fund falls into the category of investment funds. So like we see here, it's only one of the components. We have hedge funds, money market funds, and ETFs as well. But we're going to talk about more about mutual funds today. So mutual fund is a investment type that collectively invests in different asset classes like equity, debt, and others as well. So this mutual fund is a investment that focuses on specific asset classes at a particular time. So for example, equity mutual fund. Equity mutual fund will focus more on investing in different equities, like let's say blue chip companies, small companies, mid-sized companies. So it's going to focus and diversify the investments into the equity asset class. Similarly, with debt funds, that's going to invest more into government bonds, corporate bonds. And with money market funds, it's going to invest more in money market instruments like T-bills, like let's say commercial papers. And for hybrid funds, it invests both in debt and equity. So it's a good mix to kind of hedge yourself towards the downturn of the markets. And coming to gold funds, it's going to invest more in gold-related investments like gold shares, let's say gold trusts as well. And since we can kind of estimate that these keep on changing every single day, right? So the price of equity changes every day, and so does debt. And since mutual funds are kind of based off of these asset classes, the mutual fund value changes every day too. So, for example, let's say this particular mutual fund invests in Reliance Company and Infosys Company. So it holds 50 shares of Reliance and 60 shares of Infosys. So let's say on this particular day three, the Reliance share is valued at 800 and Infosys at 1500. And since it changes every single day, let's say on day four, Reliance goes up by 50 and Infosys, let's say, goes down by 100. So the value of the portfolio changes accordingly. But if you see the bigger picture here, you will not see a big change in the total mutual fund value because the loss made in Infosys is going to be offset by the profit made in Reliance, right? So that's the liquidity component of risk that we kind of dissolve with diversification in a mutual fund. But what makes mutual fund, let's say, more competitive or different from other investments in the market? Mutual fund is an open-ended fund. It means that as more people invest in a mutual fund, the mutual fund is going to issue new units or shares to the particular investor. But let's say if I were to go and invest in an individual stock trading in the open market today, let's say Reliance for that matter, if I buy Reliance share today, I am going to buy shares that are already trading in the market. So if I'm willing to buy one share, there has to be a seller willing to sell one share as well. So that creates a liquidity problem in the market. But for mutual fund, that is not the case, as there are new shares issued and sold in the market every single day. So let's talk about more features apart from liquidity today. So let's talk about affordability. So since there is a pool of investors pooling their money together towards a particular fund, the cost of that fund also gets divided amongst those investors. So I get to buy in various securities and diversify my portfolio at a very lower cost. And that brings us to the point of diversification. So with that little cost, I get exposure to various different equities, which I probably wouldn't get if I were to invest individually in those stocks. And the main feature I feel, or main advantage of mutual fund, I feel, is the professionally managed component of it. There is a professional assigned that is going to take care of the mutual fund and make all the decisions as to where that money should be invested and what securities should be bought for that fund so we can maximize returns for the investors. So you get to kind of leverage the skills of that professional to get maximum returns for your investment. And as we discussed the liquidity point, it is a really important component when looking at individual investing as well. And finally, I would say the regulatory segments of mutual fund. Mutual fund are really well regulated, though I would say that Mutual funds don't are not particularly covered by the CDIC, that is the Canada Deposit Insurance Corporation, but there is protection for investors like you and me. For example, the assets held by a mutual fund, they should be held by a third party called custodian, which usually happens to be a chartered bank or a trust company. And there is an annual review done by independent auditors that release annual reports for investors like us to review and kind of see what the assets are doing or how they're performing in that mutual fund. And there are also funds set up to protect investors in case a mutual fund goes bankrupt. So let's say CIPF here, the Canadian Investor Protection Fund. So they protect us up to $1 million if we happen to be eligible customers of IIROC member firm, that is Investment Industry Regulatory Organization of Canada. And similarly, we have MFDA, the Mutual Funds Dealer Association of Canada, in place. They have an investor protection fund called Securities Investor Protection Corporation, SIPC, which again gives us protection up to $1 million if we happen to be eligible members of MFDA. So that's more on the protection side. But if we look at the fees, right? All investments come at a cost, and same is for mutual funds. Mutual funds have mutual funds have something known as sales charge and MER. So these all affects and kind of eat up into the investment returns. So you have to be really careful in picking your investments. So when we come to a sales charge, so there has to be a commission that is paid when you buy or sell the fund. And if you happen to pay this commission when you buy it, it's called sales charge or front end load. But if you happen to pay it when you sell it, it is called deferred sales charge, or you can say back end load. And there are some funds that operate on a no load basis, which means that you don't have to pay any sales charge when you buy or sell the fund. Now, coming to MER, this is more of a compulsory or can you say mandatory segment of the cost, which is like a total of management fees and also operating expenses of the mutual fund. So you don't directly pay into these, but the fund pays an annual fee to the management company that is managing the funds and investments for them. And the operating aspect of the MER is basically a total of, let's say, legal, accounting fees, custodial fees, and others. And you would majorly read MER as a percentage of the fund's assets. So that's more on the cost part of it. Now let's look at taxation, because when we talk about income or investment, we always talk about taxation on the other hand as well. So how are mutual fund taxed? So first, let's understand what kind of income aspects can we look at when talking about mutual funds. So you can expect returns in two ways. First is you expect returns in capital gain or capital loss. So if today I were to invest and the fund value is $50, but tomorrow it goes to $60. So I have made a capital gain of $10, and vice versa. If the fund value goes down by 10 to 40, I'm got a capital loss of $10. And the other component depends on which kind of fund you invest in. So let's say if I invest in equity mutual fund, I'm going to be incurring an income maybe in form of dividends, right? Or maybe if I go for debt mutual funds, I'll be incurring an income in form of interests. So you can expect income in form of capital gain, capital loss, that is basically capital appreciation, or maybe dividends or interests. And there are taxations for these both type of incomes. So let's say if you held your mutual fund inside of a registered plan. So let's say an RRSP and let's say RESP or DSP or let's say even a RIP for that matter. You won't be paying any taxes on the income earned as long as the money stays inside of this plan. But when you withdraw the money from this plan, the whole amount that you withdraw is going to be taxed as any other regular income. But if you were to invest in mutual funds that are held outside of a registered plan, you are going to be charged taxation on all these income as if they were broken down. So as interest, dividends, capital gain, and they're going to be taxed according to the taxation laws in Canada. And also all these distributions that you receive in form of interest and dividends are going to be taxed in the year that you receive them. So mutual fund gives you the option to kind of cash these out or reinvest them back automatically. So depending on what you select, you are going to be tax on if you held them outside of the registered plan, irrespective of what you select, cashing out or reinvested back. So every year you're going to be charged a taxation on these distributions. And remember, all this is going to kind of affect your investment returns as well, because it's all about how much you can keep when you invest, right? So that's taxation. And moving on kind of like summarizing the whole process of mutual fund investing, let's say from buying to selling. So first are investors. I, being one investor, I invest money in a mutual fund along with millions of other investors. So all of our money is pooled together in this one particular fund, and that is being managed by a professional fund manager. Now, that person has skills to invest and kind of select securities and analyze which is going to do best for our investment goals, and select securities that fit our goals the best. And he's going to make sure that the fund generates maximum returns for us, which is going to be passed on to investors in form of dividend, interest, or capital appreciation. And of course, if we choose to sell, we're going to be eligible to pay taxation on the same kind of returns that we get. And the cycle goes on. You can always move out and kind of cancel the plan if you want to, but again, that's subject to different rules as well. And the last component for today is factors to consider when investing in mutual fund. I believe every investment has certain groundwork to be done. And for mutual funds, I think these five kind of factors stand out the best. First being the risk component. You should always analyze as to how risky the mutual fund investment or any particular investment is for you. Does it meet the risk appetite you have? Maybe if you're investing for a particular goal that you have in place, but maybe the mutual fund that you are going for has a different goal or doesn't meet the risk appetite that you have. So looking at the risk appetite and the fund goals is really important, because let's say I have income needs. I want regular income every single year to meet any particular part of my life, right? So if the fund does not provide that goal or does not meet that goal, it might not be the right investment for me. So that's more on the risk and fund goals aspect. Moving on to fund performance, I feel it is really important to analyze how the fund has performed in the past, though it is not 100% reliable, because past does not define future, as the markets change every single day. But the trend, of course, is visible, and you can kind of estimate as to how the fund might do in the future. And it's a good kind of good to know point. So you can kind of manage the risk accordingly when you're investing in that particular fund. Coming to the fund cost, like we said, it is important to know that how much you can keep after having the returns in place. So you should compare kind of the service and the cost that the mutual fund offers to you. If you feel it is justifiable, then it might be a good investment for you. But it's also a good option to kind of compare other funds with the services that this particular fund offers to you when comparing the fund cost. And lastly, but majorly, I feel knowing your fund manager well, kind of doing your research on the fund manager, their education, their experience, maybe they have held other funds before, kind of looking at how that fund performed is important, because at the end, the success of a mutual fund lies entirely in the skill set of the fund manager. So I feel these factors are really important before you go forward and select any mutual fund, because it's a long-term commitment, and kind of knowing and doing your research is important before putting your money in any investment for that matter. So I hope we covered everything on the mutual fund today, and hope to see you soon. Thank you.